Rigged from day one, America's economic cheat code exposed. The world thinks American prosperity is built on freedom and hard work, but the truth is far darker. The U.S. has been operating with a hidden financial cheat code that forces the rest of the world to fund its debt and consumption. We're exposing the rigged system that made America a superpower and why it's about to break. For 80 years, the United States has enjoyed an unparalleled economic advantage, allowing it to spend without consequence and accumulate debt that would cripple any other nation. This isn't luck. It's the economic cheat code, a set of structural rules, written by the U.S. after World War II, that guarantees its financial supremacy. We break this cheat code down into 5 foundational mechanisms that systematically transfer global wealth and risk to the American balance sheet. The core of the cheat code is the exorbitant privilege, the ability to print the world's reserve currency, forcing other nations to accept and hold dollars to conduct essential trade, especially oil, the petrodollar. This unique demand allows the U.S. to finance its massive budget deficits simply by issuing more debt that the world must buy. The second part of the code is state-funded innovation and risk transfer. Revolutionary technology from the Internet to GPS is paid for by the U.S. taxpayer via defense and research agencies, like DARPA, with the finished, de-risked product then handed to private U.S. corporations for massive profit. The third, cruelest element is the global talent funnel, where the U.S. systematically imports the world's most educated minds, draining the intellectual capital of rival nations at zero cost. These mechanisms, combined with the strategic weaponization of finance, sanctions, create an asymmetrical system that has been rigged from day one. Understanding this cheat code is the first step to protecting your wealth before the rising global resistance led by BRICS finally unravels it. To uncover these hidden truths, stick around and make sure you subscribe to Secret Wealth Tactics. The foundation of modern American global supremacy is not built solely upon military might or cultural export, but upon a deliberate, institutionalized financial mechanism that grants the nation an asymmetrical and unfair economic advantage. The exorbitant privilege. This mechanism, operationalized through the U.S. dollar's role as the world's primary reserve and trade currency, acts as America's fundamental cheat code, forcing the rest of the global economy to subsidize U.S. consumption, debt, and geopolitical projection. This privilege, established amidst the ruins of World War II, remains the single most powerful tool in the American financial arsenal. The formal genesis of this unparalleled financial anchor lies in the 1944 Bretton Woods Conference. Emerging victorious and virtually unscathed from the global conflict, the United States held an overwhelming majority of the world's official gold reserves. This physical, quantifiable dominance provided the unique authority to dictate the terms of the post-war financial order. The agreement established a fixed exchange rate system where the U.S. dollar was the only currency directly convertible into gold, pegged at a rate of $T35 per ounce. All other major global currencies were, in turn, pegged to the dollar. This institutional arrangement was the first, and most critical, act of rigging the system. By making the dollar the anchor, the U.S. effectively transitioned from being the world's largest creditor to being the world's sole financial issuer of the global reserve currency. The dollar became the indispensable unit of account, medium of exchange, and store of value for central banks worldwide. This privilege, a term famously coined by former French finance minister Valéry Giscard d'Estaing, conferred a massive, unearned benefit upon the United States government and its citizens. The practical operation of the exorbitant privilege is simple, yet profound. It means the United States can purchase goods, services, and strategic assets from anywhere in the world by merely printing and issuing its own currency. Currency that the rest of the world must accept and, critically, must recycle back into the U.S. financial system. This reality allows the U.S. to run persistent, massive trade deficits consuming far more than it produces, and budget deficits spending far more than it collects in taxes, without suffering the immediate, devastating consequences that would cripple any other nation. A country like Argentina or Turkey with a fraction of the U.S. debt and deficit would face hyperinflation, capital flight, and currency collapse. The U.S. faces relatively benign market conditions because the world's central banks are compelled to finance its debt. This dynamic creates the powerful, self-sustaining debt recycling loop. When the U.S. imports goods from China, Germany, or Saudi Arabia, it pays in dollars. These dollars accumulate in the reserves of the exporting nations. To prevent these dollars from flooding their domestic markets and causing hyperinflationary currency appreciation, and because the world needs safe, liquid reserves, the central banks of these exporting nations are forced to buy the safest, most liquid asset available: U.S. Treasury securities. In essence, the U.S. sends dollars out for goods, and the world sends those dollars back as cheap, abundant credit, thereby funding the U.S. national debt. The rest of the world provides the goods and the capital, while the U.S. provides the paper. The structure faced its greatest challenge in the early 1970s, when persistent U.S. fiscal deficits led to global skepticism, and foreign nations began demanding gold for their dollars, draining U.S. reserves. The initial Bretton Woods gold anchor model collapsed in 1971, when President Nixon unilaterally suspended the convertibility of the dollar to gold, the Nixon shock. This event, which should have ended the dollar's supremacy, instead led to the establishment of the ultimate financial cheat code, the petrodollar system. In the mid-1970s, the U.S. negotiated a series of strategic agreements, most notably with Saudi Arabia, the largest oil exporter. The implicit covenant was devastatingly simple. Saudi Arabia would price its immense oil exports exclusively in U.S. dollars, and in return, the U.S. would offer security guarantees. This framework was swiftly adopted by the OPEC bloc. The consequence was that oil, the essential commodity powering the global industrial and logistical economy, must be purchased with dollars. Any nation needing oil, whether Germany, Japan, or Brazil, was fundamentally compelled to secure dollars, thereby ensuring perpetual, artificial global demand for the U.S. currency, entirely decoupled from its gold backing or fiscal prudence. The petrodollar system cemented the dollar's position, transforming it from a gold-backed currency into an oil-backed currency. This secured the U.S. cheat code for 50 more years, ensuring that the two most critical global commodities, oil and finance, would be inextricably linked to the dollar. It is the single most important structural reason why the U.S. has been able to accumulate over $35 trillion in national debt, without facing the sovereign default or hyperinflation that would have crushed any other developed nation. The world is structurally mandated to fund the U.S. debt and accept its currency, a rigged system operating under the guise of free trade. If the exorbitant privilege provides the financial engine for America's economic cheat code, the mechanism of state-funded innovation and risk transfer provides the intellectual capital and technological fuel. This is the second, equally crucial, element of the rigged system, operating largely outside the public spotlight and directly contradicting the popular narrative of American free market, entrepreneurial ingenuity. The hidden truth is that the most disruptive, market-creating technologies underpinning modern American corporate dominance were neither invented nor initially funded by private venture capitalists. They were conceived, financed, and nurtured by the U.S. taxpayer via government agencies, only to be strategically handed over to private corporations for massive, de-risked commercial profit. The U.S. government functions as the world's ultimate, most patient, and most risk-tolerant venture capitalist. Private capital, by its nature, is geared toward short-term returns and recoils from the immense cost and high failure rate inherent in foundational scientific research, the kind of research that may take decades to yield a commercial application. The U.S. government, primarily through its defense and intelligence apparatus, steps in to fill this gap, assuming the burden of the high-risk initial investment. The most exemplary manifestation of this policy is the Defense Advanced Research Projects Agency, DARPA. Established in 1958 inches response to the Soviet Sputnik launch, DARPA was deliberately shielded from short-term political and quarterly market pressures, allowing it to pursue high-risk, high-payoff research that often had no immediate commercial viability. The mandate was simple: secure technological superiority, irrespective of cost. The results of this state-led innovation are the very bedrock of the modern global economy, making this mechanism a true cheat code. Consider the foundational elements of the digital age: the Internet, the original architecture and protocols, ARPANET, and later the TCP/IP suite, were entirely conceived, designed, and funded by DARPA. Without decades of sustained public investment, the infrastructure for the global Internet would simply not exist. GPS, Global Positioning System, developed, launched, and maintained by the U.S. Department of Defense. This utility, requiring billions in taxpayer funds for satellite construction and deployment, is provided free globally and is essential for every modern mobile application, logistics firm, and defense system. Microchip technology. Much of the early research that led to modern integrated circuits and high-performance computing was driven by military and NASA requirements, subsidized heavily through government contracts and funding guarantees. Voice recognition, Siri, and touch-screen technology. Key foundational patents and developments in these areas trace back to research funded by DARPA and other federal labs aimed at improving human-computer interaction for military use. This system is formalized by the risk transfer mechanism. The state finances Phase 1, 2, and often 3 of basic, expensive, and uncertain science. It tolerates the 90% failure rate inherent in frontier research. Once the technology reaches a point of technological readiness where the immense scientific risk has been retired, the intellectual property, IP, perfected technology, and foundational protocols are strategically transferred to the private sector. This transfer occurs through favorable licensing agreements, defense contracts that subsidize scaling, and simply by making the standards, like TCP/IP, open source. The consequence is an asymmetrical financial win for private U.S. corporations. Companies like Apple, Google, and the entire biotech sector reap the massive commercial profits generated by market-creating technologies: the iPhone, the Google search algorithm, advanced pharmaceuticals, without ever having incurred the initial, crippling, decade-long R&D costs. The taxpayer assumes the burden of failure. The private corporation captures the wealth of success. This mechanism allows the U.S. private sector to continuously dominate global high-tech industries with a subsidized, guaranteed competitive advantage, an advantage unavailable to purely private enterprise in any other nation. Furthermore, this state funding mechanism is sustained and justified by the massive, continuous expenditure on defense. The annual defense budget, the largest in the world, is not just an expenditure on security. It is the world's most powerful, consistent source of demand and funding for advanced technology. This guaranteed demand underwrites entire strategic industries, from aerospace to advanced microchip fabrication, providing a stable revenue pipeline that protects U.S. technology firms from market volatility. This is the ultimate form of industrial policy, discreetly and consistently executed under the necessary and politically untouchable guise of national security. The systematic conversion of public money into private profit through technological superiority is the second pillar of America's economic cheat code, ensuring that the U.S. maintains its lead in generating future wealth and power. This structure starves international rivals of IP and forces them to perpetually play catch-up, securing American technological and financial dominance for another generation. The first two pillars of the American economic cheat code, the financial leverage of the exorbitant privilege and the technological head start provided by state-funded innovation, are ultimately sustained and amplified by the third, and perhaps cruelest, mechanism, the systematic engineering of the global talent funnel. This is the process by which the United States systematically imports the world's most educated, ambitious, and high-skilled labor, effectively draining the intellectual capital of rival nations at zero cost, and ensuring that the returns on global educational investment overwhelmingly accrue to the U.S. economy. The financial advantage of this system is immense and often overlooked. Developing highly skilled engineers, specialized doctors, and leading scientists requires massive, long-term public and private investment in primary education, university systems, and expensive doctoral research. Nations across Asia, Europe, and Latin America spend billions of dollars annually to educate their brightest citizens. The U.S. system, through its world-class research universities and its vibrant high-tech ecosystems, like Silicon Valley, acts as a strategic siphon, attracting these finished, highly productive human capital assets precisely at the peak of their earning and innovative potential. The global talent funnel operates in a few critical stages. The University Magnet, U.S. Universities, heavily subsidized by state and federal research grants, often tied to the DARPA, NIH pipeline, maintain global leadership, acting as the initial magnet. They attract the world's best students for graduate and doctoral programs. These students, often paying high tuition fees, immediately contribute to the US's academic ecosystem, working on cutting-edge, publicly funded research. The retention trap. Upon graduation, the best and brightest foreign students are often offered opportunities to stay in the U.S. through mechanisms like optional practical training, OPT, and the H-1B visa program. While politically controversial and often restrictive, this immigration framework is designed to prioritize and retain high-skill labor that fills critical, commercially valuable gaps in the U.S. economy, particularly in engineering, computing, and life sciences. The entrepreneurial capture. Crucially, this retained talent forms the backbone of the American innovation machine. Studies consistently show that a significant percentage of the founders and key executives of the most valuable U.S. tech companies, including Google, Microsoft, Tesla, and numerous startups, were either first or second-generation immigrants. The intellectual property, IP, the jobs, and the enormous capital gains generated by these highly productive individuals are thus legally and physically captured within the U.S. tax and legal jurisdiction. This sustained brain drain starves competing nations of the very human capital necessary to launch rival innovation ecosystems. A nation like India, for example, spends billions educating a top software engineer, only to see that individual emigrate to the U.S., contribute their peak productivity to a U company, and pay their substantial taxes to the U.S. Treasury. The U.S. enjoys the full financial return on a global R&D investment it never paid for. This is a perpetual, self-sustaining cheat code that ensures the U.S. maintains its technological superiority over rivals who lack the same magnetic draw or have less flexible immigration policies. Furthermore, the stability and scale offered by the U.S. financial and legal system act as a crucial complement to the talent draw. High-skilled individuals are attracted not just by salaries, but by the promise of scale, the ability to access the massive U.S. market, the deep venture capital pools, fueled by the exorbitant privilege, and the robust, predictable rule of law that protects intellectual property and private contracts. In a volatile world, the legal sanctity and financial depth of the U.S. ecosystem make it the safest and most lucrative place for ambitious individuals to pursue wealth creation. In effect, the global talent funnel merges seamlessly with the state-funded innovation pipeline. The U.S. government funds the research infrastructure, and the immigration system ensures that the best global minds staff it. The result is a perpetual competitive advantage, guaranteeing that the U.S. is always at the leading edge of foundational technologies like artificial intelligence, quantum computing, and advanced biotechnology. This third cheat code is perhaps the most resilient, as its underlying driver, human ambition, and the pursuit of opportunity, is the most difficult for rival nations to regulate or replicate. The technological and human capital advantages secured by the prior cheat codes are rendered globally enforceable by the fourth, and perhaps most strategically ruthless, pillar of the American system, the financial weaponization and geopolitical control inherent in the dollar's dominance. This is the mechanism that transforms the dollar from a neutral medium of exchange into the ultimate tool of coercion, allowing the U.S. to enforce its foreign policy objectives through financial decree and exert unparalleled power over the sovereignty of other nations. The core of this weaponization lies in the control over the global financial plumbing, specifically the SWIFT Society for Worldwide Interbank Financial Telecommunication Network and the dollar clearing mechanisms. Virtually all major cross-border transactions, especially those involving energy or finance, must ultimately be settled in dollars and clear through U.S. regulated financial institutions. This jurisdictional control grants the U.S. Treasury and the Federal Reserve the power to unilaterally impose sanctions that can instantly and completely cripple entire national economies, banks, or even individuals by cutting off their access to the indispensable dollar system. The freezing of the Russian central bank's $$300 billion in foreign currency reserves in 2022 was the watershed moment that exposed the full, terrifying power of this cheat code. It demonstrated to every sovereign nation, ally and adversary alike, that holding vast reserves in dollars, the world's supposed safest asset, is a political liability. This action transformed the dollar from a reliable reserve currency into a tool of strategic warfare, forcing nations to recognize that their financial sovereignty is ultimately subservient to U.S. foreign policy objectives. This fear-based coercion creates a powerful, self-reinforcing geopolitical control loop. Nations comply with U.S. sanctions and regulations, often extraterritorially, not out of political alignment, but out of a paralyzing fear of being cut off from the global financial system. Banks and companies worldwide are forced to choose between maintaining their essential access to the dollar and facing catastrophic fines or exclusion. This systemic control extends U.S. legal and regulatory authority far beyond its physical borders, making the Treasury Department perhaps the most feared and potent foreign policy arm of the U.S. government. This financial weaponization is inextricably linked to the debt recycling loop established by the exorbitant privilege. As foreign nations generate trade surpluses and receive dollars, they must recycle these dollars into U.S. assets, primarily treasuries, to maintain financial stability. This mechanism forces them to continuously fund the U.S. debt and deficit. The cheat code is fully deployed when a nation is compelled to earn dollars due to the petrodollar system, is compelled to hold those dollars due to the lack of alternatives, is compelled to finance U.S., is compelled to finance U.S., is compelled to hold those dollars, is compelled to finance U.S. debt with those dollars due to the reserve requirement, faces the threat of financial exclusion if it fails to comply with U.S. political directives. The U.S. enjoys an asymmetrical advantage where its economic rivals are structurally obligated to fund its consumption and finance its military projection. The geopolitical control is maintained by ensuring the global financial system remains concentrated and dependent on the dollar's infrastructure. This strategic over-leverage of financial control, however, has recently begun to backfire, giving rise to the final, critical vulnerability in the American system. The widespread application and aggressive nature of U.S. sanctions have accelerated the global countermovement towards de-dollarization. Nations like China, Russia, and the expanded BRICS bloc are now urgently pursuing alternative payment systems like China's CIPS and bilateral trade settlements in local currencies. This collective effort is aimed not at destroying the dollar, but at reducing its indispensability and creating pockets of financial non-alignment that are immune to U.S. coercion. The long-term risk of the financial weaponization cheat code is that its overuse compels the world to seek alternatives, slowly eroding the structural demand for the dollar. As more global transactions bypass the dollar, the debt recycling loop weakens, forcing the U.S. to rely increasingly on domestic buyers for its exploding debt, which translates directly into higher interest rates and increased inflationary pressure on the American consumer. The power of financial weaponization is absolute in the short term, but its long-term cost is the gradual dismantling of the very privilege it seeks to protect. The preceding analysis has meticulously dissected the core of America's economic supremacy, identifying 5 foundational mechanisms: the exorbitant privilege, petrodollar enforcement, state-funded innovation and risk transfer, the global talent funnel, and financial weaponization that collectively form the nation's economic cheat code. This code is not a matter of luck or superior free market performance. It is a meticulously constructed set of structural rules that systematically compels the rest of the world to subsidize U.S. debt, finance U.S. consumption, and surrender its intellectual capital. This system, operational since the mid-20th century, has granted the U.S. an unparalleled, asymmetrical advantage, allowing it to spend without consequence and issue the world's reserve currency with impunity. The inevitable financial implication of this rigged system is that, for 8 decades, the American public has enjoyed a standard of living subsidized by foreign nations, a privilege paid for by others absorbing U.S. currency risk and funding U.S. deficits. However, the critical conclusion now is that the aggressive, indiscriminate overuse of the financial weaponization cheat code, particularly the freezing of sovereign reserves, has triggered a strategic, Irreversible counter-movement. Nations, led by the expanded BRICS bloc, are no longer willing to accept the dollar as a neutral, risk-free asset. This active pursuit of de-dollarization is the strategic time bomb set to dismantle the entire framework. The result will not be a sudden, catastrophic collapse, but a gradual, relentless erosion of the dollar's indispensability. As the petrodollar system weakens and the debt recycling loop slackens, the U.S. Treasury will be forced to rely more heavily on domestic buyers to finance its exploding national debt. This shift translates directly into permanently higher interest rates, significantly increased debt servicing costs, and entrenched inflationary pressure, the direct cost of losing the exorbitant privilege. The financial stability that Americans have long taken for granted is now ending. For the shrewd investor and wealth strategist, this geopolitical shift represents the single most important macroeconomic factor of the decade. The imperative is clear: you must pivot from assuming perpetual U.S. financial supremacy to hedging against its structural decline, while simultaneously positioning capital to benefit from the established U.S. technological and IP dominance that remains intact. Wealth strategy. Navigating the end of the cheat code. The strategy to navigate the unraveling of the rigged system must be built on three core, actionable principles. Hedge the currency, capture the IP, and diversify the risk. 1. Hedge the dollar's structural erosion with hard, neutral assets. While the dollar remains dominant, the long-term trend of its purchasing power is downward due to debt monetization and the loss of foreign subsidy. Actionable strategy. Gold and hard assets. Adopt the central bank strategy. Physical gold and high-quality gold mining equity should be a non-negotiable component of your portfolio. Gold is the ultimate, non-jurisdictional defense against the debasement of all fiat currencies and the political risk associated with any centralized payment system. Furthermore, increase exposure to real, productive hard assets like strategic farmland, natural resources, and commodity producers, which inherently retain value when currencies weaken. Actionable strategy. Treasury positioning. Avoid long-duration U.S. Treasuries, which are most exposed to the structural rise in interest rates as the U.S. is forced to attract domestic funding. Favor short-term Treasury instruments or Treasury inflation-protected securities, TIPS, to defend against the inevitable inflation that will accompany domestic debt monetization. 2. Capture the enduring IP advantage. Even as the financial cheat code unwinds, the technological and human capital advantages secured by the state-funded innovation and global talent funnel mechanisms remain potent. Actionable strategy. Invest in the monopoly winners. Maintain core exposure to U.S. big tech, specialized software, and defense-linked technology firms. These companies still benefit from the taxpayer-funded R&D pipeline and the ability to attract and retain the world's best talent. Their technological monopolies provide pricing power that can often withstand periods of currency volatility and inflation. This is where the output of the cheat code still resides. Actionable strategy. Strategic U.S. sector exposure. Invest in U.S. industrial and energy sectors benefiting from government subsidies, IRA, CHIPS Act, and domestic energy stability. These sectors are the direct beneficiaries of the capital hemorrhage from the energy-stressed UK and EU. Diversify. Geopolitical risk. A multipolar world. The geopolitical landscape is shifting toward a multipolar financial system, with BRICS seeking financial autonomy. Ignoring this shift is financially dangerous. Actionable strategy. Commodities and non-aligned markets. Dedicate a portion of capital to commodity producers and strategic infrastructure in nations that are not fully aligned with the U.S. financial hegemony. This includes emerging markets that are direct recipients of capital and trade flows bypassing the dollar system. Investing in commodities priced outside the traditional dollar framework, for example, resources tied to local currency trade with China, BRICS, provides a hedge against the fracturing of the petrodollar system. Final call to action. The age of the undisputed American economic cheat code is drawing to a close. The systemic shock of financial weaponization has forced a global strategic counter-response, and the cost of this unraveling will be paid by the American consumer through currency debasement and structural inflation. You have witnessed the intricate mechanisms that have rigged the system for decades. Understanding them is the first, most crucial step in wealth preservation. You cannot afford to wait for the official confirmation of the dollar's decline. the smart money is already moving. If you are ready to transition from being a passive participant in a rigged system to an active, prepared beneficiary of the emerging financial order, if you want the specific, high-conviction strategies to hedge against the erosion of the dollar and profit from the global shift, then you must act now. Join the ranks of those who understand the hidden financial truths that move markets. Hit that subscribe button, join the Secret Wealth Tactics community right now, and turn on those notifications. We will guide you through the systemic changes, ensuring your wealth survives and thrives as America's economic cheat code finally breaks.